Welcome to Stringent Syndicate. If you're paying attention, you know that you only make money when you work. It might be great money, but it's dependent on you. The information on this podcast will help you solve that. We interview experts and provide analysis into financial freedom through commercial real estate. Why? To help physicians like you thrive. Let's dive in.
Welcome to Stringent Syndicate. This is your host, Dr. Michael McManus, and we are here today with Randy Smith. Randy, welcome to the show.
Thank you so much for having me, Mike. Really excited to be here, or Dr. McManus, I guess I should say.
Either way is fine. For all the doctors listening, know that when you're outside of the hospital, often having the doctor label go away is nice. All right. Well, Randy is founder of Impact Equity, which was formed to help investors achieve strong results in their passive real estate investing strategies. Randy and Impact Equity have helped more than 90 plus investors place over $6.3 million across 3 operators and 12 different opportunities since launching in June of 2022. Randy started his real estate investing career doing out-of-state single-family long-term rentals, and he quickly realized the many additional benefits he could receive by switching his strategy to passively investing in multifamily syndications. Randy is now invested in 24 different passive investments with 10 different operators, which gives him a unique knowledge and expertise to recognize a strong passive opportunity. Currently resides in Peoria, Arizona with his wife, Jenny, and has spent 25 years working in various business development and leadership roles in corporate America. All right, Randy, welcome to the show. So tell us a little bit more about your journey into real estate.
Yeah, so I, as the bio kind of shared there, I spent about 25 years in corporate America in various sales roles. And I was sharing with you earlier, like I spent 10 years with 2 different organizations, and both of those ended up with layoffs. And the first time that I got laid off, I was like every other sales guy in the world. You'd get a big bonus check, you'd go buy something fun. Maybe I'd max out the 401k, but I wasn't accumulating alternative streams of income as I would later do in my second career. So when I got laid off that time, I did get a severance package, and every month that would pass, it got a little more scary about what it was I going to do. Like I was at the time, I think I was just barely late 30s, early 40s, and clearly had another 10, 15, 20 years under my belt. So fortunately, I did end up landing at another great Fortune 100 organization and had, probably the best 10 years of my career after landing at that organization. But about midway through my tenure, I ended up deciding that I wanted to start focusing on some real estate. And like so many folks do, I ended up starting in the single family space, and I bought some turnkey rentals and figured out that that wasn't a model I wanted to pursue, for scale. Then I shifted over into the out-of-state single-family BRRRR strategy, which I found was a really great way to create capital, but it was anything but passive. And then finally, I landed at passive investing in multifamily and self-storage and many other asset classes, and that's kind of where I found my passion in the space and found what I consider to be one of the best ways to invest in real estate.
So tell us a little bit more about what you're doing now and how this folds into that whole passive investing strategy.
Yeah, so I had actually invested, when I ended up getting laid off the second time, I had invested in, 15 or 18 different LP positions. So passive investments in a specific investment opportunity. And a large portion of my monthly expenses were covered from, true mailbox money that was hitting the account on or around the first of the month. And being a sales guy, I had shared with everybody that I knew what I was doing, and had referred a ton of money to one of the operators that I was investing with So when I got laid off and was trying to figure out what is this next phase going to look like for me, or what is this next chapter going to be, I ended up connecting with that operator, and he suggested that I might consider professionalizing that referral process, essentially. And I launched into this process of creating what is known as a fund to fund model, where my investors invest into my funds, and then we bring much bigger checks to various operators. And because we're bringing larger checks to those operators, we end up getting preferred returns, or much better returns than what the traditional retail investor gets. So I had some success with that early on, and doubled down on it and realized that there was an opportunity, there was a business there to scale what I had done. And fast forward, coming up on a couple of years, we've helped a lot of people place their first, second, or third passive investment in this great space.
So what advantage does that bring to the investor? So I'm scared doctor here, because doctors are very conservative and we get scared easily.
Sure.
So investing in a fund to fund with somebody like you versus going out and finding different operators. What are the benefits or the downside of that model?
Yeah, good question. So, I very quickly shifted over to this as a full-time profession. So I actually probably spend more hours working today than I ever did when I was working in the W-2 world, transparently. So I have become very well versed at vetting operators, vetting deals, sifting through the many, many, many deals that are out there, and really identifying the best opportunities that might be in the market space at any given time. And I've also been able to build very strong relationships with a handful of operators that most retail investors would have a pretty challenging time getting as much face time with these folks, doing the due diligence that I do, and really getting to know these guys. So most of the operators I work with, I've had, many years experience with and relationships with. And my level of due diligence usually exceeds what the traditional retailer is doing. So there's always that piece of it. So my expertise is really what I'm bringing to my investors. Now, in addition to that expertise, I'm also bringing better economics to my investors. So the fact that I'm bringing usually anywhere between $500 and $1 million to these operators, it's beneficial to them to work with more folks like me, so they have less check writers that are bringing bigger checks versus having to deal with all of the investor relations that come with $25 or $50 or $100,000 check writers. So, I'm going to bring better economics to my investors that they then get to share in those benefits with our fund. A few other benefits would be that generally my minimum investments are much lower than what the operators have. I will generally have larger windows to bring investors to their deals, because a lot of these big players, they will launch a deal and fill them up almost in the same day. And I quite often have, 35, 45 days, even 60 days to bring investors into those opportunities. So really gives the investor the opportunity of building one relationship with an expert allocator like myself. And then I bring diversification to my investors, because I'm working with 5 different operators now, and I do probably one deal a month. So I can put a very large number of opportunities in front of my investors as well.
So, all right. So for the investor, instead of them having to vet each deal and each operator, that you're doing a lot of that vetting for them. Yep. As far as everybody being on the same page, if you don't bring good investments or good operators to the people writing you checks, they're going to stop writing you checks. So you're incentivized to make them the best deals possible for the people who are investing with you. And on the other side, the operators, you're incentivized to bring them reliable money, or else they're going to go look somewhere else.
Exactly.
And so it's kind of lined up that it benefits everybody. I was like going, okay, where's everybody's motives, and are we all aligned in the same direction?
Yep.
And so instead of the operator having to go look for investors and go find 100 people to invest, they can go to a fund like yours and 1, 2, or 3 of those. And now they only have to deal with a smaller number of people as far as investments.
Yep.
And they can focus on operating their deal.
Yeah, and it's an interesting model where exactly that last point that you said is that I would prefer my operators be focused on finding the best assets and finding and managing these assets as best as they possibly can versus chasing all the administration and relationship capital that is out there. That is ultimately, it's a full-time job. It's usually one of 3 main practices of these operators. You've got asset management, acquisition, and then capital. So if I can take the capital piece off of their plate, then they can focus on what they do best. As you were talking through this too, I thought of one other thing that might be beneficial. And, most operators out there are generally they're focused on one type of asset class. They're focused on one type of business plan, and they have one investment structure that they're bringing to their investors. And, what I found is if you schedule 10 calls with operators, ultimately, they're going to determine that their investment is the perfect investment for you versus having a view where you can see multiple business plans that actually bring very different things to the table. By understanding what an investor is truly looking for, you can find the right investment opportunity that matches their needs versus trying to put a round peg in a square hole, like I think so many of these operators do. Like myself, when I first came in, the main difference between the two is, are you a cash flow investor or a growth investor? And honestly, when I first started passively investing, I didn't even know. I found out later when I got laid off, I was a cash flow investor, or I should have been a cash flow investor. Because if you have all your money tied up in equity and there's no monthly cash flow, and all of a sudden there's a need for income, you find out really quickly that maybe you should have done something different there.
It's a great point. And I think even from, the unexpected happens. Because you think like, okay, well, I'm years away from retirement, and maybe it's worth having a blend that even if you're not near that point where you expect to need the cash flow, but to have the cash flow. I like the cash flow emotionally, just to look and see. Absolutely. Like, because when you invest a bunch and you're like, okay, look there, I locked up across multiple deals, I got $1 million invested that I can't get back for some set period of time, and sometimes the end of that expected set period of time has to be longer than we had hoped to make it work. And then if you don't see any money coming in, it's just a flat number out there. And so emotionally, right. I like to see some numbers come in. I
agree.
Or even where you got laid off, Doc goes through burnout and decides, I don't know if I can do this anymore, if I can't do it as much. And I know when I went halftime, it was nice to see some other money still coming in through the adjustment, because I hadn't, I'm going to admit that I hadn't really answered that question really well. And I was more just buying deals I liked and just figured it didn't matter. I would reinvest the stuff that came in, and the stuff that was longer term was really for the future. But all of a sudden you're like, oh, I like that cash flow.
Yeah, absolutely. Absolutely.
We'll get back to our show in just a minute, but first I want to offer you an opportunity to accelerate your learning. My life changed, and my ability to start becoming work optional changed when I gained the people and the knowledge to start investing in commercial real estate. One of the key people there was Ash Patel, and joining his Invest Beyond Multifamily Mastermind. Well, that mastermind is no longer open, but for a fraction of the price, Ash has now made a course. And this is probably the most valuable set of information and quickest way to move along your learning curve. So if you are interested in actively investing in commercial real estate and retail and industrial and office, I would recommend this course to you. We're going to include a pre-sale link both in the show notes. It'll also be on the surgeonsyndicate.com website. And in your checkout, it'll save you another 1%. I know it's not a lot, but every little bit helps if you use the discount code Mike1487. If you're not interested in investing actively, give us a call here at Fortress Capital, And let's talk about what your goals are as a passive investor. But it's time to stop listening, start acting, and let's move your future forward.
So through the fund, do you actively look for some diversification, either across different property types, markets, so you're offering that within one spot?
Yeah. So when I launched Impact Equity, the goal was to provide diversification across deals and operators, business plans, because different business plans drive different results, asset classes and geographies. So over the last 18 months or so, I've been able to accumulate various operators that satisfy different pieces of that diversification model that I've been trying to satisfy. And I'm pretty close to being able to cover all of the different facets, but we'll likely start looking at some different asset classes in the future as well. Today, we're short-term rentals, multifamily is probably 80%, and then we're doing a debt fund as well. So it's a good option for the cash flow investor.
So as part of this, when you're looking at it, you're also looking at it from your perspective. Like,
of course.
What do I want coming in? And that's usually then finding people who want the same thing as you, seeing a little
exactly. Bit. Yeah. So that is it. It's probably about 80% or 70% of my portfolio is multifamily. And I end up, personally, I've invested in self-storage. I've looked at I actually am invested in a car wash here locally, mobile home parks. I love the industrial space, an ATM fund, all kinds of different things. So, yes.
I heard somebody talking today on a group call about ATM funds.
Yeah.
And I had no idea, because you think about ATMs now, and 20 years ago, I went to the ATM all the time. Now,
yeah.
I don't know, a few times a year, every other month. And I was like, well, why are ATMs a thing? And I learned that a lot of government payments now come on a debit card, that's how they get the money. You don't go down to the office and pick up a check or cash. Right. You get a card and they reload that card, and you go to an ATM and you pull cash out.
Yeah.
And so there's a portion of the population that are still very dependent on ATMs.
What do they say? The underbanked, those people that don't have strong banking relationships have a bigger need for the ATM space. And there's actually a subsection of that market that is geared towards the crypto markets as well. So cryptocurrencies can be traded through ATM or administered. I don't know the technology behind it, but they're being used in that space as well. So
I've seen that recently, where you look for an ATM and it shows you crypto ATMs.
Yeah. I don't play or invest in that space at all, but it's fascinating for sure.
It is. It's a fascinating new place. So in the education work you do, so is your, if you're the face of the fund and somebody who's new to this coming in, what's the education role that you play?
Yeah, so it really depends on the specific investor. Some investors are very sophisticated. They've invested in the space. They understand the process, and at that point, it's more of a relationship piece, or it is somewhat of a deal shopping at that point. For the newer investor, this can be a very nerve-wracking space. It can be it's scary. I mean, the first time you go down to a bank to wire $100,000, I remember double, triple, quadruple checking the numbers to make sure that it's going. And inevitably, the banker on the other side tells you about, little Susie who lost $50,000. So, that can be a scary process. Even filling out the legal paperwork and the private placement memorandum can be just extremely overwhelming when you're staring at 120 pages of legal documents. But really, when that new person gets into the space, it's more important, I think, to train and educate just on the big picture of how these types of investments can be used in conjunction with what they're already doing, and the different benefits of why you would choose alternative investing over the stock market or in addition to the stock market to create a balanced offering. So it really depends on who the investor is and how sophisticated they are as to the amount of, I call it hand-holding. Like literally, I can walk you through step by step from, vetting the operator to understanding the deal to understanding the metrics, giving some guidance on tax strategies that, of course, they want to double check with their CPA, and then really just the fundamentals of the logistics of how this whole thing works. So there's a lot of information that's available, and the good capital allocator or syndicator will take the time that new investor is really needing to spend early on to make sure that they feel comfortable with the process.
And that's okay. For doctors, like we're used to, you're supposed to be the expert and know everything. And it can be really hard to come into something and feel like you know nothing. And that it's okay to, at some point, everybody started there. You had no idea what you were doing. And
everybody wants to start day one and be an expert, right? No, I understand, definitely.
And and the thing is you need to educate to a point. And we all, you read books, you listen to podcasts and all these different things. But I find myself, and I think everybody is, you can only learn so much until you start doing it. Yeah. And the day you buy that first investment, you pay attention on a totally different level. Yep. And you learn and you see things change in the economy. And now it means so much more than if it's theoretical money.
Mm-hmm. I agree. And I find a lot of investors that they want to jump in, and like myself, I wrote a $100,000 check for my first passive investment. And I will actually discourage people from doing that early on, because I think it's more important to diversify your dollars across a few different operators and a few different asset classes and deals, just to learn, because you can read an investor deck and listen to a presentation and get an idea of what it is that you're looking for. But until you're wiring funds and you're logging into portals and you're getting distributions or you're not getting distributions, like you don't even really know what you're looking for. So by spreading that $100,000 investment into four $25,000 investments, you can get a good idea of the different type of offerings that are out there and when some will be better than others, and learn what it is you as an investor like. Like, I would rather take slightly less returns and have good communications from an operator than have better returns but never hear from it. So, but I know that because I'm in 25 LP positions and I know what I like and I don't like. But I think it's better to learn those lessons on smaller checks than it is big checks.
And we had talked about this before, because some investments require $100,000 minimum. So you can either search for different ways that will take less. But we'd had this discussion before about how you can partner with friends and have an investment club. And you told me about a platform that does that. Tell me a little bit more about this, because I think I originally thought of this because people came to me who are a little earlier in their career and they're like, I don't have that much to invest, which maybe at that point, it's, you can make lots of different arguments, whether it's the right investment or whether you should invest that in yourself and make more money first. Or if you've got a giant pile of cash, but you just don't want to throw it all in one direction right away, it's a way that you can enter deals with a smaller amount up front. So tell me a little bit more about the different ways you can do that.
Yeah. So, as you mentioned, you can find an operator that takes $25,000 investments. Some might even do $10,000 investments. Very few will do that. But most, if not all of my offerings are $25,000. Now, if you're dealing or you want to deal with smaller checks even than that, there's a group called TribeVest that partners very closely with an investment community called Left Field Investors, which is, to all the investors, I would say, try to find a community where you can talk with people about these types of investments as part of your vetting process. But what TribeVest does is it allows individuals to come together, and they will actually create an LLC and set up a bank account, and they will provide guidance on all of the accounting and tax requirements of that entity, but ultimately give you the ability to pool your dollars into one investment, and then that investment entity places the capital in a 25 or 50 or $100,000 minimum investment. So it gives you the advantage of being able to spread your dollars across multiple operators while having a community aspect as well to invest with friends or colleagues or family members and to spread your dollars and find the diversification that you're looking for. So it's a really great tool to get started until you're able to write bigger checks. But it is also important to note that there's some drawbacks to that as well. Whenever you're forming business entities with other people, those are partnerships that they're going to have to last for 3 to 5 to 7 years, depending on the investment. And there are tax requirements. So as you form an LLC or a partnership, you have to file partnership tax returns every year. And that can cost, $1,000, $1,500, $2,000 per partnership return. So that's going to eat into your returns as well. So it's important just to be aware of that when you get started, because that could be a big surprise if you've made, $500 in returns, and you got to kick out $200 for a partnership tax return at the end of the year. So.
And it happens all the way across, because that's why, because some people say, they're like, well, why do these deals, why do they want $100,000? It's really because the operator's looking at it that they want as few of investors as possible, because it's less administrative cost, fewer K1s they have to make, less. And so the smaller their minimums, the more their administrative costs, which eats into everybody's returns.
Yep.
So there's a benefit to the investor too of having higher minimums. Absolutely. But for somebody looking to get started, sometimes you just have to go, and that maybe that price of that extra tax return is part of the cost of admission of the education of actually getting in the game and going.
I agree. I always share with my investors, like, 25 grand is not going to make you rich, and it's not going to make you poor. But I guarantee you, within the next 6 to 9 months to a year, you're going to understand how this space works, and you're going to feel that much more confident when you're stepping up and making a decision to invest in other deals as well. So,
yeah. And if you only have 25, that maybe there's somewhere else that would be better for that first. If that's your whole life savings, putting it in one deal, just from that diversification standpoint.
Absolutely.
If it's all in one spot and one thing goes wrong, that's where you want to not have your entire life savings all sitting in one spot.
Yeah, it's a good point. We talk a lot in this space about, because there's a requirement that the investor, either one, is accredited, or two, they're a sophisticated investor, and that you have a pre-existing and substantive relationship with them. So, what does it mean to be sophisticated is a very gray definition, and you can line up 10 different SEC attorneys and ask their opinion, you'll get 10 different answers. But, I think it's important for folks to know, whether you're accredited or not accredited, most of these investments are illiquid investments, meaning as a passive investor, you invest the dollars and you don't have a vote on when they execute the business plan, when they sell the asset or refinance it. So you're handing the dollars over, and you're truly letting them become the stewards of those dollars, to trust that they're going to take care of them. So, as an investor, it's important that that you're picking somebody essentially to watch over your dollars for 3 to 5 to 7 years. So, there are the liquidity issues, and then you also have, probably the biggest one is that these have significantly more risk, and it is possible that an investor can lose their entire investment, albeit it's very unlikely that's going to happen, but it does happen from time to time if you pick the wrong operators and you're in the wrong investment. So it's critically important for folks to know that those two things apply.
That's an interesting difference, because it can also happen in the stock market where, some things that looked really good can go horribly wrong. I owned stock at one point in Ericsson Phones, which I believe I waited for a bump to sell it, so I didn't have to pay the fee because it was worth less than the sales cost.
Okay. Wow.
Where your $2,000 was now worth $3, and if you couldn't pay the $7 sales fee, they charged you $25 to liquidate it. So
Okay.
it can happen with stocks too.
Fair enough.
And they are, because if you're investing passively as a limited partner, you don't have any liability beyond that, which as a general partner, you could. The good side of being illiquid, because you hear a lot of the talk about this, when you listen to anything like CNBC, and one of the knocks on the corporate world over the last few years has been such short-sighted vision, because a lot of managers, and they get bonus, they get evaluated on short-term results, on quarterly stock price, quarterly earnings, and so often they're only looking 3 months down the road or 6 months down the road, and not looking 3 years, 5 years down the road. So
sure,
if you're in it with somebody for 3 to 5 years, at least they're looking at, like, when you're evaluating an operator, you want to know what their plan is for the next 3 years, because what can happen in 3 years.
Right.
Interest rates can go from 3% to 8%.
Exactly in a year, right? Yeah.
It doesn't happen that often, but there are things that require somebody to have a bigger vision. But that's a benefit of liquidity too.
I agree. Yeah, and you find that people make emotional investment decisions in the short run that have a tendency to hurt them. So yes, the illiquidity is actually a benefit just as much as it can be a drawback as well.
So with those irrational decisions, that's a great lead in to the next part of where I want to take this conversation. But for now, we're going to wrap up this first part of the show, first part of our conversation here with Randy. So Randy, thank you for being here so much. And we'll see you back for the second half. For our listeners, please join us for the second half of our interview with Randy Smith on our next episode.
We'll get back to our show in just a minute. But first, I want to offer you an opportunity to accelerate your learning. My life changed, and my ability to start becoming work optional changed when I gained the people and the knowledge to start investing in commercial real estate. One of the key people there was Ash Patel, and joining his Invest Beyond Multifamily Mastermind. Well, that mastermind is no longer open, but for a fraction of the price, Ash has now made a course. And this is probably the most valuable set of information and quickest way to move along your learning curve. So if you are interested in actively investing in commercial real estate and retail and industrial and office, I would recommend this course to you. We're going to include a pre-sale link both in the show notes. It'll also be on the surgeonsyndicate.com website. And in your checkout, it'll save you another 1%. I know it's not a lot, but every little bit helps if you use the discount code Mike1487. If you're not interested in investing actively, give us a call here at Fortress Capital, and let's talk about what your goals are as a passive investor. But it's time to stop listening, start acting, and let's move your future forward. This has been an episode of Surgeon Syndicate. If you got value from this episode, you know other surgeons are hungry to become job optional, and you can help them by sharing this content today. Schedule a call and we can make a plan. Looking forward to having you with me on the next episode.